Hello everyone, this is Juan Sarmiento and today is Wednesday, May the 31st. Okay, here I have quite a few candidates and I want to sort through them. You can really easily look at the implied volatility and pick the ones with the most implied volatility and see if it makes sense. Another approach, which is more mathematically, is to go through each one of them, all right? Click on the item and go to the Analyze tab. And here we are going to look for the 30 days. So June 30th is the closest thing. And then look at the intrinsic and extrinsic value. And then you have here the intrinsic value is 0 and the extrinsic 1.5 for the June 47 strike price. And here you have it. And if you look at the risk profile of that short call, it would tell you how much money you're getting, $1.50. But this stock is $46 a share. So you, in theory, could, based on our limits of $10,000 per trade, you can theory sell 2 along with your calls. Okay, so that gives you $302. But that's not exactly 100. So it is 46 times 2 is 80 plus is about 92. So really when I say you should trade something, make sure you get about $500 return on the 10,000. Well, this is not 10,000, it's less than 10,000. So we have to sort of transform that to be fair. So do the same for all your trades. Hallmark, and this is Halliburton rather. And here we go at simulated trades, look at the one with the 0 intrinsic and something extrinsic, and that's the 29. Okay, so let's put 29, and that's $1.37. You're going to multiply that 3 times. You could do 3 times, and you could get $411. But to be fair, we have to transform that to what if it was 100. To be fair, to equally compare, to fairly compare all of our trades. If we compare all of them. Okay, so let's continue on doing this. And I'm going to pause here and I'm going to create a spreadsheet in which I would say all the stocks, you see them, they match. The stock price currently, that has changed because I entered this before the market opened. The at the money call, what would the price be? And then we'll proceed from there. So I'm going to put a pause here, be right back. Okay, I'm back, and what I have done is enter here the at the money call price. This is actually the extrinsic value only, okay? So that I can then see how much of the extrinsic value, this is a value that would expire or that will go to 0 by expiration, all right? So multiply that by 100 and divide it by the stock price. And that will give you an estimate of what would it be if the stock was $100, because we want to compare apples to apples, or we want to compare all the stocks as if they were 100 in price. And then that way I could see which one would actually give me the best price for my money. And so here you can see that they're all around $500. Some closer than others. So we have the best price here is on Roku and MU. Those are the best two. So I can certainly enter those, and they are more than 500. And if more than 500, I'm happy with that. Okay, because that means that if I invested $10,000 on those, I have the potential to make $500 on those trades. But overall, you know, you just want, some will be more costly than others based on the stock price. And then you multiply, you see, when in the case of MU and Roku, you only need to buy 1 share because they're $68. Something wrong here, because yeah, Roku is really 57, so we need to put 57.1, right? And so that's even better, is $600, okay? 57, we're only going to trade one $100 share or one call, all right? So that looks great, and this one looks great too. So Roku and MU. I confused those two. It is upside down. Let's see, let's change that. 57.1 for Roku, and MU is 68.4. 51. Okay, so that's better. Okay, the Roku is 661. That's what I'm gonna get on expiration with this. So we can definitely trade that and trade this other one, and just imagine that we're spending only $6,851, not the full 10,000. Okay, the Roku 57. We can't really do two of those, or perhaps we could, but I doubt it. And then we could do the X. We're going to do four of those. Okay, let's see how that works. Okay, so we're going to trade Roku, MU, and X. Starting with the Roku, go to find the. Let's delete all that. And just to verify, we are selling the extrinsic $4. That's the 57. So click on the bid, and that gives you the cover call. And here it is. We're going to get $400, $395. If we were to do two of those, then it would be a whole lot more. But we can't really, because it will surpass my $10,000. So again, let's just click on here, the same option, and I say buy cover stock. Here it is. And here the maximum is $404, but we're investing a whole lot less than 10,000. So I'm going to do this one here, and remember that I'm going to the split in my margin account and my cash account. So create duplicate order, confirm and send, multiple, and I'm doing a cover call for each. And the margin, of course, is half the price, or the buying power effect, as the IRA. If we were to do two of them, then it will surpass 10,000. So I'm not going to do that. Okay, I'm going to do only one, because my maximum will be $10,000. Okay, so let's send that. Let's do the same with MU. Okay, MU, add simulated trades, and here we have what is our option with the maximum extrinsic value while having zero intrinsic value. That's the 69 June 30 with 30 days to expiration, and my risk. Okay, that got filled, and now we have the Roku got filled. Let's see. Here is the MU is $360. Okay, that's how much I'm expecting to get, $360. Okay, but I'm investing only a fraction of the 10,000 maximum that I could trade. Okay, so here I go and say analyze buy, cover stock, and here's my risk graph. Right here, my maximum here will be $420. Okay, let's do that. So by comparing to apples, meaning correct for that $100, because this is less, we are making sure that overall we expect 500 times 10 when we select the stock. So here we are, and create duplicate order, confirm and send. And then the last one is X, and X, of course, is a $20 stock, so let's look at it here. How much first I'm going to select the option with intrinsic value 0, and that was the MU got filled. Oh, I did only one-sided. Let's repeat that, okay? MU. Let's say all. Let's look at the margin here. In the margin, I didn't do the MU, so I need to do that. I overlooked that. So let's MU, create duplicate, same price, and confirm and send, but we're going to send it to the margin account, and that's going to be $3,000. Okay, it's half the price of the cost if there were right here. If we were in an IRA account. So let's send that off. Okay, let's go back to X. We go here to the June 30th, and as I said, let's click here first on the bid, and that gives us the call. All right, and here it is, risk graph. We would be getting $104, but we would do 4 or 5 of them, right? Let's see. Yeah, probably 5 would be okay, in which case we'll get close to $500. Let's see, do the cover call on that. Analyze SPY, cover stock. Here's my risk graph. And look at how it's reduced from the 20.75 goes down to 19.68 because we're selling a call on top. And multiply this 5 times. And then we have the potential to do $650. None of that, not all of that is extrinsic value. But this will work. And again, create duplicate order, confirm and send, and we're going to do multiples. And we're going to do 5 for both the margin and the IRA accounts. And we're going to get close to $10,000, as you can see, in cost on the IRA, in half of that for the margin account. Let's send that off. Okay, you would probably realize if you look at the current account positions that we are missing here the Caesar Palace, Caesar Entertainment. That didn't get filled. I tried several times. It didn't, so we're going to exclude that. Now, you can see that the account, it originally went up, but you can see the year to date. Okay, we did close the Marvels at a $500 profit, and I didn't do anything else with that. That year to date, we have a slight loss of $348. This goes up and down, it doesn't matter. The stock may depreciate, but so does the call. And we are trading this for the long run. Obviously, if the stock goes down to 0, we are screwed, because we lose all the value of that trade. But we assume that's not going to happen. What is most likely to happen is that the stock will go up and down, up and down. At some point, it will come up and neutralize compared to the original trade price. But the option itself, that extrinsic value that I always calculate as my target, that will go away, which means I keep the $500 or so on each trade. So this is the basis of doing this cover call account. So don't worry about the value until we begin to roll over our calls or perhaps closing positions. Right now, it doesn't matter. If the stock goes up the way it did with Marvel, then we close the position. If it is so high that it makes no sense to roll it over. If the stock goes down, then the volatility would increase, and then our options would be more expensive, and then we can do rolling. We can roll them as we get closer to expiration. We will do that as we get closer to expiration. Right now, we're not near expiration on any of our trades. Okay, that's all for today. Thank you very much for joining me. See you next time. Bye-bye.